There is one key point that we need to understand right now. The fact that the Trump administration has begun defending itself against the surge in gasoline prices tells us something important. The shock from the Middle East conflict has already moved beyond the realm of military news and is now spreading into consumer prices and financial markets. Barron's reported that the Trump administration is pushing back against soaring gasoline prices. Reuters also noted that officials are explaining the rise in energy prices as being driven more by fear and market psychology than by an actual collapse in supply. But the market does not see it that simply. Right now, the market is not focused on war headlines. It is focused on oil prices. And the real question investors are asking is whether those oil prices could once again shake inflation expectations, interest rates, and stock market valuations. The average price of gasoline in the United States has already climbed to $3.32 per gallon, the highest level since last September. To ease the surge, the administration has even allowed temporary exemptions related to sanctions on certain Russian oil supplies in an effort to reduce pressure on the market. The very fact that such measures are being discussed shows how sensitive the situation has become. What matters even more, however, is what comes next. Barron's warned that if the conflict involving Iran were to escalate and Brent crude were to surge toward $150 per barrel, gasoline prices in the United States could once again exceed $5 per gallon. That is not the base case scenario today, but the market has already begun pricing in the possibility. Politically, the pressure is also growing. Gasoline prices are one of the most visible and immediate costs that American voters feel in their daily lives. If the conflict drags on and oil prices continue to rise, the White House will have to defend not only its military strategy, but also its economic messaging. According to Reuters, even within Trump's political base, the combination of a prolonged conflict and rising fuel costs is emerging as a sensitive issue. For investors, however, the most important variable is the Federal Reserve. Recently, there have been signs of slowing employment growth in the U.S. economy. Under normal circumstances, that kind of trend could strengthen expectations for interest rate cuts and support equity markets. But if a surge in oil prices is added to the equation, the situation changes. The Federal Reserve could find itself facing a difficult scenario: slowing growth while inflation risks rise again. And that is where markets begin to react. If oil prices move higher, growth stocks, especially those in the NASDAQ, will face greater pressure from higher discount rates. Consumer-related sectors could also start reflecting weaker spending as gasoline prices rise. On the other hand, energy-related assets are likely to remain relatively strong. Ultimately, there are four key indicators investors should watch. First, whether Brent crude stabilizes around the low $90 range. Second, whether U.S. gasoline prices continue to accelerate higher. Third, whether the Trump administration introduces additional measures such as strategic reserve releases or supply-side adjustments. And fourth, whether the U.S. stock market, particularly the NASDAQ, can withstand this shock. To summarize, this is not simply a story about gasoline prices. It is a process in which war is translating into real economic costs, and those costs are feeding back into interest rate expectations and equity market valuations. In the current environment, the market is not moving because of the sound of gunfire. It is moving because of oil.